welcome back. So, in the last lecture I was talking about option Greeks. We will continue from there, but before we do that, a quick recap of where we stand right now. I introduced option Greeks with the first option Greek being delta. Delta represents the sensitivity of the price of the position or the option with respect to the price of the underlying, and positions of positive delta as is apparent will increase in value when the price of the underlying increases, and vice versa. That is also seen through this expression which is the truncation of Taylor series to first order. Call delta ranges from 0 to 1 and put delta ranges from -1 to 0, and call delta increases with increase in the stock price. For out of the money calls, call delta would be pretty close to 0, and as the stock price increases, significantly and the call becomes in the money, the call delta approaches 1. As expiration approaches, the in the money call delta approaches 1 very rapidly towards with short expiration times. The out of the money call delta also approaches 0 very rapidly, and the at the money calls are somewhere in between. Delta hedging, as we have discussed, comprises of taking positions in the underlying assets with respect to our original position in the derivatives in such a way that the position becomes delta neutral as a delta value of 0. Remember, the delta of a portfolio is equal to the weighted average delta of its constituents. So, we can make the delta 0, and if the delta is 0, then the partial derivative is 0, delta is nothing but the partial derivative. So, partial derivative of the value of the position with respect to underlying price is 0. What does that mean? That means that if the underlying price changes by an infinitesimal amount, the value of the position does not change due to the change in the position of the due to an infinitesimal change in the value of the underlying asset. So, that is important, but there is another important thing that the call price curve or the function of the call of the underlying asset, the call price as a function of the underlying asset is a curved representation, and therefore, the value of delta at different points along that curve will change. The delta at a particular point will be different from the delta at a different point. As a result of which, if a portfolio is delta neutral at one point, it would not be delta neutral at another point, and rebalancing will have to be done in order. Rebalancing means either taking longer or short positions in the underlying asset, so that we again achieve delta neutrality. The extent or the frequency of rebalancing, you see, a delta neutral portfolio is neutral or is immune to price changes for a very small price range of the underlying asset. As soon as the price range becomes significant, delta value will change, and the two components of the portfolio will become out of phase, and we will have a hedging error. This hedging error is basically due to the curvature of the call price curve with respect to the underlying price, and this curvature is captured by gamma. So, that is how gamma comes into the picture. Gamma captures the curvature of the call price with respect to the underlying asset, because as I mentioned earlier, the call price is not a linear function, of the price of the underlying asset. So, what do we have then? If the curvature is less, that means gamma is small, then the hedging is robust and extends over a reasonable variation in the price of the underlying asset. But if gamma is large, that means the curvature is very high. That means that the hedging error that would be there even for a small change in price of the underlying asset would be significant, and therefore, it will call for a very frequent rebalancing of the portfolio of the or rather rebalancing of the constitution or the composition of the underlying asset, so that the delta neutrality is maintained at different points. So, gamma, as I mentioned, measures the curvature. Technically or mathematically, curvature is measured by the second derivative, and therefore, the derivative of the slope with respect to the underlying asset, which is nothing but the second derivative of the call price with respect to the underlying asset. So, gamma is the first derivative of the delta with respect to the underlying asset, and the second derivative of the call price with respect to the underlying asset. Long options have positive gammas, short option positions have negative gammas, and the gamma of out of the money options as well as the gamma of deep in the money options approaches 0, and gamma has a maximum value more or less close to the exercise price of the option, in other words, for at the money options. As expiration approaches, this is very important for short maturity options. In other words, as expiration is very close, gamma becomes very volatile or takes very high values, very high positive values for call options which are at the money, and the out of the money and the in the money call options, gamma that approaches 0, but at the money call options, gamma approaches very high positive values. Now, when volatility is low, as I mentioned in the last lecture, when volatility is low, the chances of an in the money option moving at the money or an out of the money option moving at the money are very remote or are insignificant, and therefore, the gamma of in the money and out of the money options is pretty much 0, pretty close to 0. However, at the money options is high, has a high gamma when the volatility, despite the volatility being low. However, when the volatility is high, the options can move, the prices of the options can move from in the money to out of the money or at the money. There can be movements across the entire spectrum of the moneyness of the option, and therefore, the gamma is also more reasonably or more equitably distributed across the whole spectrum of values. That is when the volatility is high. Now, if gamma of a position is small, as I mentioned, rebalancing is not regularly required. If gamma is large, you require significantly rapid rebalancing, quick rebalancing to ensure or to ensure delta neutrality of the portfolio. Positive gamma can be used to book profits. I explained that in the last lecture. Then we talked about theta. Theta is basically the partial derivative of the sensitivity of the call price to passage of time. It is usually a negative number. In other words, as time passes, the call option becomes less and less valuable. It reduces in value, its values get amortized, and as a result of it, theta is a negative quantity. And this negative quantity has a maximum negative value for at the money call options. For out of the money call options, because they have very insignificant time value attached to them, if they are deep out of the money, the theta value approaches 0. And in the case of in the money call options, the theta value approaches an asymptotic value of minus r k exponential minus r t as the stock price increases. Now, theta and expiration, again it is very much similar to the behavior of gamma. As I mentioned, at the money call options pretty close to expiration have very high positive gammas. Similarly, in the case of thetas, call options or long call option positions, very close of call options that have a very close expiration have very high negative theta, as you can see in this diagram. This particular curve at the money call options which are very close to expiration have very high thetas, and the out of the money options and in the money options, as they approach expiration, the theta tends to decline or decrease. And this is basically due to the change in time value. At the money options have the maximum time value, and as the Therefore, because they have the maximum time value, when they are amortized, when this time value is amortized over a small period of time, the loss in value per day or per unit time is very significant. However, in the case of out of the money call options, the time value is very small, and therefore the amortization is also very small, and theta is also small. So, gamma theta trade off, this is very interesting. You see, if you take a long position in a call option, what happens? And it is close to maturity, that is a short expiration call option, then it generates a high gamma, a high positive gamma, but it also generates a high negative theta. So, what is the implication of this is very interesting. Now, the high positive gamma will give you high profits, or will generate positive profits if there is a large swing in the price of the underlying asset. If the underlying asset swings changes in price either positive or negative direction, this will generate profits because of the high positive gamma. However, if the stock price does not fluctuate, if the stock price remains stable, then what will happen? The gamma profits will not materialize. However, as the time passes, the negative theta will eat into your value of your call position, long call position, and you will incur losses. So, it is in this scenario, or in this sense, we have a gamma theta trade off, and obviously the inverse holds if you have a short position in a call option of short maturity. Then we come to Vega. Vega is the sensitivity of the price of the portfolio, of the price of the option, the derivative portfolio with respect to the volatility of the underlying asset, volatility of the underlying asset. The sensitivity of the portfolio, sensitivity of the derivative, sensitivity of the call option with respect to volatility of the underlying asset. Therefore, it is the first derivative of, for example, the price of the call option with respect to sigma, and for the Black-Scholes model it works out to this expression S phi dash d1 into under root. What is this? This is the time, remaining time to expiration. The value under the square root is nothing but the time to expiration. This is the total life of the option capital T. Small t is the time that has already expired. So, capital T minus small t is the time that remains to expiration. Now, some salient features about the Vega. Vega measures the option sensitivity to changes in volatility. What is volatility? Volatility captures the fluctuations in frequency, the frequency as well as the amplitude of fluctuations of the price of the derivative product or the derivative investment or the derivative portfolio, the frequency and the amplitude of the prices of the portfolio. The higher the volatility, obviously, as you can see also mathematically, higher the volatility, higher would be the value of the what you call the option, and because d1 is a positive function of sigma, and d1 is a positive function of sigma or a monotonic function of sigma and a monotonic increasing function of sigma, and phi of d1 is a monotonic increasing function of d1. Therefore, the volatility is contributing positively to the price of the call option. Right. Higher the volatility, higher the value of the option, that is what I have explained just now. All long options are positive Vegas, and usually in the case of a bearish market, volatility tends to increase. That is an empirically observed phenomenon, that when the market tends to go bearish, the volatility tends to increase, and when the market tends to go bullish, it is relatively reduced. Right. So, Vega for it is a positive number, as you can see from this. you can go back to this. S is always positive, phi dash d1 being a PDF is always positive, and this expression being the time remaining to maturity will either be positive or 0. So, it cannot be negative. So, V can never be negative. It can be 0 as an extreme case or as a boundary condition, but otherwise Vega will always be a positive number. And in the sense of the derivative, because options, you see options obtain their value or value is generated in the options due to the uncertainty ruling in the stock price, fluctuations in the stock price. Therefore, higher the amount of fluctuations, greater the frequency of the fluctuations, greater the amplitude of the fluctuations, greater the volatility of the fluctuations, greater would be the value of the price of the derivative, price of the call option. However, you see now if you therefore, the long position in the call option will have a positive Vega, but obviously a short position in the call option will have a negative Vega. Now, the important thing is, as I mentioned in the case of delta earlier and gamma, the Vega of a portfolio consisting of a number of derivatives will be equal to the weighted average Vega of the constituent derivatives, and therefore, when you work out the weighted average, it may so happen that the entire portfolio ends up with a negative Vega. That is very much possible, although for a long calls it is a positive quantity. Why? Because calls enhance their value of a call is increased when the volatility of the underlying asset is increased. Now, Vega and stock price, as I mentioned just now, Vega is given by this expression, and as you can see, when S approaches 0, the Vega also approaches 0 naturally, but when S approaches infinity, this expression phi dash d1 will approach 0. So, somewhere in between, when the stock price is around the exercise price, we have the maximum value of Vega given by this, the product of these two expressions. As S decreases and goes towards the option goes out of the money, again Vega goes to 0, and as the option goes more and more into the money, again Vega tends to go to 0. And now, time to expiration, this is slightly different from what we have been talking earlier in the context of gamma and theta. If you look at this, higher is the time to expiration, higher would be the effect of a change in volatility on the option price, because that volatility is going to influence the option is going to be influenced by the volatility over a larger period of time. You see, basically when we talk about volatility, we are talking about standard deviation per unit time. So, if the time is increased, the standard deviation over the period is increased, and as such when you work out the value of the call, you find that the larger the time span, larger the expiration, if the volatility changes by the same amount with a smaller maturity option and a larger maturity option, the impact on the larger maturity option or the longer maturity option is pronounced for a longer period of time. The impacts hold for a longer period of time, and therefore, it translates to a higher change in value. This as you can see here also, as this factor increases, this is the remaining period to maturity. So, if the remaining period to maturity increases, this Vega will also increase, as you can see here also. This is the longest maturity option, the green line, and you can see that the Vega of this option is the maximum. So, when you buy options, Vega becomes your friend, because the Vega is positive, and if there is a change in volatility, that will generate profits for you, and if you are short in the options, you have a negative Vega, then if there is a change in the volatility of the underlying, it will result in a loss. It will result in a decrease in value of your derivative portfolio. Vega is also a function of S. So, Vega will change when S changes. it is Vega is not independent of S, as you can see here. It is a directly a function of x, it is also a function of s through this term, both these terms contain s. So, Vega is a complex function of x, s the stock price, and therefore, it will change from point to point along the price curve, along the call price curve. It is, as I mentioned earlier, it is higher for ATM options, it is close to 0 for in the money options and out of the money options. You see, the logic is simple. At the money options will get more influenced by the change in volatility, whereas options which are deeply out of the money or deeply in the money, even if the volatility changes by a small amount, their moneyness is not going to change significantly, and because their moneyness is not going to change significantly, therefore, their price is also not going to change significantly due to a small change in volatility, and that is why their Vega is very small. However, in the case of at the money options, a small change in volatility can result in a significant change in their moneyness, and as a result of which Vega for at the money options is larger. And as I have explained earlier, Vega decreases as we approach maturity. This is converse to what happens in the case of gamma and theta. Gamma and theta both increase, although gamma is positive and it increases, theta is negative and it increases, it becomes more negative in that sense, the absolute value increases, and Vega however decreases as we approach expiration. Because as I mentioned, the longer maturity options have the longer cumulative effect of a change in price of the change in volatility of the underlying asset. So, now how to construct a Vega neutral portfolio? Well, in the last lecture I explained how to construct a delta neutral portfolio. The procedure for constructing a Vega neutral portfolio is exactly similar, exactly parallel in fact. For the delta neutral portfolio, what did we do? For the delta gamma neutral portfolio, what we did? We first constructed the gamma neutrality, or by introducing a new option into our portfolio, we created the gamma neutrality, and once the gamma neutrality was achieved, then we looked at the delta. Obviously, the introduction of the new option into our portfolio changed the delta of the portfolio from its earlier value, because it will have its own delta, the new option. So, that will also be a part of the delta of the new portfolio. And now the question is, gamma is 0, we have created the gamma neutral portfolio, but we do not have a delta neutral portfolio. So, to make the portfolio delta neutral, we take a position, appropriate position in the underlying stock. Remember, 1 unit of the underlying stock or underlying asset contributes 1 unit in terms of the delta. Long position contributes plus 1 unit, short position contributes minus 1 unit, but it contributes 0 in terms of gamma. The stock addition or deletion or shorting of the stock from the portfolio or to the portfolio does not influence its gamma, but influences its delta by plus 1 and minus 1 respectively. So, the procedure is same here. You construct a Vega neutral portfolio first. Once you have the Vega neutral portfolio, work out its gamma, and then by taking a position in the underlying asset, you neutralize the delta of this portfolio. I repeat, first you construct the Vega neutral portfolio, then you look at the delta. If the delta is not 0, you take a position in the underlying asset, because the underlying asset is not going to contribute to Vega. The Vega of the underlying asset is 0, it is not going to contribute to Vega. Therefore, either by taking a long or a short position in the underlying asset, we arrive at a delta neutral portfolio as well. I think I have an example here. I will come to it. Yes, here is an example. Consider a portfolio that is delta neutral, and the portfolio to start with is delta neutral. It has a gamma of minus 5000 and a Vega of minus 8000. The options shown in this table are available for trading. See, they are available in the market. You can take positions in these options. How the position can be made gamma neutral and Vega neutral by including positions in options 1 and 2. So, my present position is delta is 0, gamma is minus 5000 and Vega is minus 8000. Let us assume that I take a position W 1 in option 1 and W 2 in option 2. Then because the weighted average delta, gamma, Vega of the constituents of the portfolio is the gamma, the delta, gamma and Vega of the portfolio itself. I repeat, delta, gamma, Vega of the portfolio is equal to weighted average of the delta, gamma, Vega of its constituents. I can write these two equations, minus 5000 which is the current value, plus, because I have taken W 1 options of option 1 and each unit of option 1 has a gamma of 0.5 and a Vega of 2.0. So, gamma of 0.5 into W 1 plus 0.8 into W 2. What is W 2? It is option 2 and this is, remember, this is gamma. So, what is gamma of the second option? The gamma of the second option is 0.8. So, we have minus 5000 plus 0.5 into W 1, that is W 1 is the position in option 1, 0.5 is the gamma of option 1, that is one option has a gamma of 0.5. Similarly, we have a W 2 number of units of option 2 and each unit or each option has a gamma of 0.8 and we want the whole thing to be gamma neutral. So, the gamma of this entire set must be 0 and we write the similar expression for the Vega. The initial Vega is minus 8000, Vega for option 1 is 2 and Vega for option 2 is 1.2, and because we have taken W 1 units of option 1 and W 2 units of option 2, we get this expression for the second or for the Vega, and we want the Vega to vanish as well. So, by solving these two equations, I get W 1 is equal to 400 and W 2 is equal to 6000. In other words, in order that I construct a gamma neutral, Vega neutral portfolio, I have to take long positions in 400 options of type 1 and 6000 options of type 2. This is given here, 400 options of type 1 and 6000 options of type 2. Right. So, now I have made my portfolio gamma neutral and Vega neutral, but let us see whether it is delta neutral or not. Is to start with, it was delta neutral, that means initially it had a delta of 0. Now, we have added these two. So, let us see what happens. Because we have added these two options, what happens to the delta? The new delta now becomes 400 into 0.6, which is the delta of option 1 in plus 6000 into 0.5, which is the delta of option 2. In other words, my new delta has, after addition of these two options, my delta has now changed from 0 to 3240. In other words, I have made the portfolio gamma neutral, I have made the portfolio Vega neutral, but in doing this process I have sacrificed the delta neutrality. The delta neutrality has now gone and I have now a portfolio which has a delta value of 3240. How to make it delta neutral? Well, I simply take a short position in 3240 units of the underlying asset. That will make the portfolio delta neutral as well. So, what is that entire thing? I take a long position in 400 units of option 1, a long position in 6000 units of option 2 and a short position in 3240 units of the underlying stock, underlying asset. If I do this together with the original portfolio, the portfolio becomes delta, gamma and Vega neutral. Let us now look at some Vega based strategies. Short premium positions like iron conduits, I explained it in the earlier lecture. Short premium means where you are getting premium. You writing options as a net this thing. It may be a combination of long and short positions, but as a net you are getting premium. The inflow on account of premium exceeds the outflow on account of the premium. So, short premium positions like iron condors or butterflies will be negatively impacted. Now, this is very important, will be negatively impacted by an increase in implied volatility, and implied volatility increases when we have a bearish trend in the market. So, bearish trend in the market increases implied volatility, and implied volatility increase will have a negative impact on short premium positions, because these short premium positions have negative VGAs. Because they have negative VGAs, therefore, an increase in implied volatility means that they will what you call, they will suffer a loss, or they will suffer a decline in value. And but an increase in implied volatility generally occurs. It is an empirical fact. It generally occurs on downside market moves. So, what do we infer? So, what is the strategy that should be followed? The strategy that should be followed is, when entering into these kind of positions, into these kind of strategies, iron condors or butterflies, which have negative VGAs, it is appropriate to start with a slightly short delta, that means slightly negative delta bias. So, if you have a negative VGA, you want to enter into a strategy which has a negative VGA, you also should have a corresponding, you would be better off starting with a negative delta as well. Negative VGA should be coupled with a slightly negative delta as well. Let us see what is the implication of this. Now, if the market stays flat or goes up, volatility is likely to decrease. Now, volatility is likely to decrease means your portfolio is likely to increase in value, because it has a negative VGA. Because it has a negative VGA and the portfolio value is declining. So, portfolio volatility is declining, I am sorry, portfolio volatility is declining, therefore, you are likely to make profit, or the value of your portfolio is likely to increase. However, what will happen due to the short delta? The short delta, when there is an increase in value, the short delta will reduce the value of the portfolio. So, there will be two opposing effects. One effect due to the negative VGA, and the other effect due to the positive or the short delta. The negative VGA, if the portfolio is stable, will ensure will increase the value of your portfolio, whereas the short delta, if there is a small increase in the price of the underlying asset, it will reduce the value. But however, in these kind of positions, the main profit is the premium that you get, and the premium that you have received will come out handy. Now, what happens if the market goes down? When the market goes down, the volatility increases. Now, your portfolio is VGA negative. So, volatility increase will result in a reduction in value of your portfolio. Your VGA is negative. So, but what happens to the short delta? Because your underlying has decreased in value, the short delta will operate in your favor. So, the value decline that you faced due to the VGA effect will be annulled by, or will be compensated to some extent by the short delta effect. The negative change in the value of the stock because of the short delta will result in a positive increase in the value of your portfolio. We will continue from here. Thank you.